What if you could generate monthly income from your investments, but without taking on the volatility of equities? In this video, I'm going to show you two monthly paying bond ETFs that are designed to act like a cash alternative while still giving you a decent yield. We'll look at how they work, how they compare to other funds, and most importantly, whether they deserve a place in your portfolio. First, let's quickly cover why we might want bonds in our portfolio in the first place. We know long-term that equities will outperform bonds, but if we're coming up to retirement or we're coming up to a purchase where we know we need the money, we don't want to take on the risk of having our money in the stock market and equities. So we still want some income, we still want some growth from our investments, but we put it into bonds so we reduce that volatility while still getting a decent return. Bonds can offer a level of diversification against equities. They tend to move inverse to the equity markets. Not always, but generally adding bonds to your portfolio would increase its diversification. You're likely to get a more stable form of income in bonds compared to dividends, which can vary depending on a company's performance and outlook. Of course, things like interest rates and many other things can affect bond yields, but generally compared to equities, bond yields will be more stable than dividends. When looking to include bonds in our portfolio, there's many different factors that we need to consider. But I want to highlight two key ones in duration and currency. Duration risk plays a massive role in the performance of a bond. This is the current yield curve for the UK. Bond prices and bond yields are inversely correlated. That means if you take out a long duration bond, such as 30 years, depending on what happens to yields, the price of that bond can fluctuate throughout the duration. So if yields were to increase on longer dated bonds, the price of that bond would fall, and you're not due to get your principal back until the end of the 30-year term. And that's why in a normal environment, you'll tend to have a higher yield for longer dated bonds because investors expect to be compensated for taking on that duration risk. So the first thing to look at when you're deciding on bond durations is if you want stability from that bond, then it's worthwhile looking at shorter dated bonds around 1 to 5 years. You may not get as high yield, but because the duration risk is smaller, the price is less likely to fluctuate. It's also worthwhile at this point pointing out the differences between investing into a single bond yourself and utilizing a bond ETF. If you were to invest into that 30-year bond, you take on that duration risk and you get compensated by the higher yield, but it means the price can fluctuate during that period. But if you hold throughout that 30 years, you're guaranteed to get your principal back at the end of that period. However, with a bond ETF, there's no maturity. Those bonds are continuously rolling. So that's why it's much more risky investing into a bond ETF with higher durations, because you can't ride it out to the end to get your principal back like you can if you just held a single bond. And the other key thing that you need to consider is the currency of these bonds. As a UK investor, if you invest into a US bond, then you have currency exposure to the US dollar, because in order to buy that bond, you need to convert your GBP into USD. That in itself isn't necessarily a bad thing, especially if the US dollar appreciates against the pound. But what we've seen so far this year is the US dollar has actually depreciated against the pound over 7%, and at points it was up at 10%. This is why you'll see UK investors who have invested in the S&P 500 look at the stock market making new all-time highs, and then they'll look at their portfolio and wonder why it's not up the same percentage. And that's because they've had to convert their pounds into US dollars, and then they've lost out due to that currency risk. Now, this is going to come down to where you think these currencies might go moving forward. Obviously, if you just invest into a GBP bond, then you don't have to worry about that currency. Yes, you might have missed out if the US dollar appreciates, but again, you're taking on more of an active decision in doing so. I would also point out that the US government wouldn't mind a weaker US dollar. A big agenda for them is to become a more export-driven economy. And if they have a weaker currency, then that makes their exports cheaper. So the two bond ETFs that I've chosen are the JP Morgan GBP Ultra Short Income UCITS ETF and the PIMCO Sterling Short Maturity UCITS ETF. They both pay out monthly and they're both actively managed. Now, generally, when we look at active versus passive in equity ETFs, we usually say just to go down a more passive route and invest into a tracker fund, because when we look at the data, a very small percentage of active fund managers actually beat their benchmarks long term. But when it comes to the bond markets, this is where active fund management can be really worthwhile. Let me show you an example. So this is the JP Morgan Beta Builders UK Gilt 1 to 5 UCITS ETF. It invests into UK government bonds with duration between 1 to 5 years. Look at what happened at the start of 2022 going into 2023. This is when the Bank of England started to increase their base rate in response to inflation in the pandemic. So because bond prices move inverse to their yields, when interest rates increased, the yields increased and therefore the bond prices fell. And you can see it fell as much as 10% in the middle of 2023. This means without the income payments included, over 5 years, this fund actually lost 7.55%. Even with the income included, it's only just broken even at 1.61%. If we now compare that to the JP Morgan Active Fund, you can see over that same period, it still experienced a drop, but the lowest it fell was as low as about 1.3%. Nowhere near the 10% of the passive fund. And even with this, without the income included over 5 years, it's done 0.49%. With the income included, it's up at 15.39%. And it's a similar story for the PIMCO Active Fund. Over 5 years without the income, it's 0.83%. Including the income, it's up at 14.12%. Now, I do need to acknowledge that the passive fund is based on bonds that have duration of 1 to 5 years, where the active funds are based on ultra short durations, around 1 to 3 years. But hopefully you get my point. And the goal with the active fund management is to try and smooth out that volatility. So they try and foresee events coming up. And granted, what happened in 2022 and 2023 with the pandemic was exceptional. Could we see that again? Who knows? We can also compare that volatility. And if you look over any time frame, 1, 3, or 5 years, the passive fund is always higher than the two active funds. And that low volatility and increased stability is exactly what you want from a bond ETF, especially when you're having monthly payments. In terms of yield, the JP Morgan fund currently yields 4.56% and the PIMCO fund currently yields 4.35%. On Just ETF, the PIMCO fund does actually get classed as a money market fund, but technically and legally, an ETF can't be a money market fund. EU have very strict rules of what a money market fund needs to have. It goes into very specifics about average maturities to further increase that stability. But because this video is focused on ETFs, we're not going to cover money market funds here. But typically there is quite a lot of overlap between these two active funds and your classic money market fund, which is designed to act as a cash alternative, but to offer a cash plus return. You can see from the objective of the PIMCO fund that the aim is to generate a maximum current income without neglecting capital preservation and liquidity. That's exactly what you want from a monthly paying bond ETF with a decent yield. So what are your alternatives? And you may look at these yields and think, well, they're not that much higher than just simply holding cash in a high yield savings account, but without taking on the increased complexity and potential risk of going into a bond. And you're absolutely right, that could be an option. If you were to look at trading 2-on-2, any cash held in their stocks and shares ISA gets a rate of 4.05%. That money is held in money market funds. If you hold money in their cash ISA, that is actual cash, and that gets a slightly reduced rate of 3.85%. So there is clearly a yield premium by going into these bonds. And the other thing you need to consider is what's going to happen in the future. And if you were to look at the trajectory of the Bank of England base rate, it is likely that it's going to continue to come down. We don't know at what rate and how quickly, and whether that's going to be this year or into next year or the year after. If the base rate does come down again, then that will immediately affect the yield on cash savings. In the bond market, that will feed into that as well. So yields will slowly start to come down. But because bond prices move inverse to those yields, even if the yields come down, the bond price is going to go up. So when you look at your investment, you're not actually going to lose out. So it depends on where you think base rates might move in the future. But it's one thing to consider. Like most things with investing, it's usually a balanced approach that works best. If you want monthly income, you may be looking at dividend ETFs. And I've done a separate video on that if you haven't watched that already. But you may be worried about the volatility. And by adding a small part of your portfolio to these monthly bond ETFs could help to smooth that out. And then once the portfolio is set up, you could then play around with the weightings depending on your circumstances. If you've got a long time horizon, you could have the majority of the portfolio investing into the higher yielding dividend stocks. But then as you come closer to a potential need for the money, say you're saving up for a deposit on a house, or maybe you're coming close to retirement, you could then shift the weightings of that from dividends more towards some of these shorter duration bonds, which is going to increase your stability, act as more diversification and more stable form of income, but still getting monthly payments. And the final slightly subtle point here is that when we talk about monthly income, a lot of people expect that to act just like a salary getting paid straight into your bank account. But with most platforms, and it's worthwhile checking on the platform that you use, if you were to invest into an ETF, either dividends or bonds, that dividend or income doesn't actually get paid automatically into your bank account. It will usually get put into a separate account on the platform. Of course, you can then manually withdraw that to your bank account, but it doesn't work automatically. There are some platforms like Hargreaves Lansdown, which have mutual funds, which do have an automatic function where the income can be paid directly to your bank account, but that can be another video in itself. Now that point might not be that important to you. Going into your account and manually withdrawing doesn't take that long. But for some people, they do assume that if they get income or a dividend, it will just get paid directly to them because they want the most hands-off approach. So something just worth considering. If you want me to cover mutual funds that pay out or any other type of product, then let me know down below in the comments. Let me know your thoughts on these funds that we've discussed today. Is monthly income worth it? Or is it better just going down a more conventional route? Thanks for watching. I'll catch you in the next one.